Good morning, everybody. Welcome to the weekend general update for the 27th of August. And just yet again another really tumultuous week and lots of action. So let's get in and have a review. So first of all, the important information about the fact this is general advice only. So we're giving you guidelines and a framework to trade against, but at the end of the day, the trading decisions are all yours. So let's have a look at the action for the week. And we saw the S&P index all over the place, but closed up 4.3% for the week after a pretty stunning rebound on Friday night after initial plunge. I found that that turnaround fairly confusing because what I was expecting was if Bernanke didn't come out with any new stimulus, which is what happened, that markets would sell off, and that's indeed what happened. But the amazing thing was it only lasted about 10 minutes, and then the markets just promptly turned around and screened back up again. So I find that very, very confusing, and I'm not even going to try and explain it. Now the ASX 2 excuse me, the ASX 200 outperformed again, and outperformed the US market, that is, and closed 5.5% higher for the week. And look, I really think at best I'm looking for a broad sideways market here. I really can't see our market regaining an upward trend with all the things that are happening in Europe at the moment. So I think sideways at best, and a distinct possibility of further downside and new lows. Gold closed down $26 on the week, but the range was an unbelievable $206 for the week. If you go back, say, 4 or 5 years, that range was nearly a third of the total price. So the volatility in gold at the moment is really just quite amazing, which is good for traders if we can get on the right side of it. Excuse my cough. The symmetry on gold, as we'll see, is still working pretty well. So amongst all this volatility, there is still a degree of predictability about it, as long as we manage around the extremes. Silver closed down 3.7% for the week, so it did a little worse than gold on a percentage basis, but silver is always more volatile anyway. And silver will follow gold in terms of gross direction, but it's possible it could break out because silver didn't have the excesses that gold did. And copper finished at $4.10, so finished higher on the week, which is good to see copper rebound, because that's always a good indicator of the health of the economy. And when I say that, the health of the economy and the health of the banking system are two completely different things. So don't be confused by things that I might say in that regard. I think the banking system in Europe and to a degree in America is absolutely shot to pieces, whereas there are some aspects of the global economy that are actually going along quite well. So I'm talking about manufacturing and trade and all those sort of things. Okay, let's have a closer look at gold, because I think that's where the trading opportunities are at the moment. And we had a massive drop from overbought situation. The price had gone parabolic and had to come back, and so that was pretty normal. It pulled back to exactly 1740, and we'll have a good look at this on the chart. So it pulled back to the first retracement level, right on cue, stopped there on the official close of that day. We then got an intraday spike to a lower level, just over 1700, which kind of fooled me, because I thought, well, it's broken the first level, it's going down to to the next level, which was under 1700. Didn't quite make it, turned around intraday and roared back up again, and actually finished back above 1744. So that was that was a little surprising. Then we had a rebound from there, which is what you'd expect. So 2.5 very savage days down. Then you get a rebound. That's absolutely normal. And so I then expected that rebound to go as far as 1781 to 1806, which was all good. Prior to the announcement on Friday night, we then turned back down again, having not gone beyond 1806. I think got down to something like 1730, but then again finished up at nearly 1830. So from here, how far will that rebound go? I believe it'll probably peak out at somewhere below 1870. That's a little bit rubbery, but somewhere between where we are now and 1870, I think, is where it will peak out. And then, as I've said before, the overwhelming probability is that we do not just get a sudden 3-day massive sell-off and then a rebound straight back up again. It just doesn't work that way. You normally get an ABC pattern to the downside, so I think we're in the B leg up. I think the C leg down is still to come. Now the question then is, how far down does the C leg go? I think if it's a less severe correction, in other words, if the buying forces are good, then it'll probably go to the low 1700s. Excuse me. If it is more severe, then it'll quite possibly get down to 1643, which is a pretty key level and fulfills several technical requirements. So let's just have a look at gold on that on that basis. So let's zero in here. So you can see if we take the run from the 1st of July this year to the high just a few days ago, and that July low was really where the last run started, then you can see that we've got three retracement levels: 1744, 1694 and 1643. The price declined on Wednesday night to exactly 1744, exactly to the dollar. We then traded down, as I said, got to a low of 1703 intraday, but rebounded back above that level, and then really went through with it on Friday night and closed up at 1826. Now, I've drawn a retracement here from this high on Tuesday to the low on Thursday and put a retracement scale on that, and that was where I felt that the market could rebound to maybe 1781 or at most this 1805, 1806 level. Now it's gone straight through there, which indicates greater strength, and it may well fizzle out at 1829, 1830, but I wouldn't be surprised to see a little bit of overrun. This was such a powerful rebound on Friday night that a little bit of overrun wouldn't surprise me. So I doubt it'll get any higher than 1870, and then so this is our, let me draw this out here. This is our A leg. Sorry, wrong one. This is our A leg down. Then we're getting a B leg up. Let's say it goes up to here. And then we still get a C leg down. Now the question is, where does the C leg finish? Does it finish somewhere around about the lows of Thursday night? Or does it in fact come all the way down to here to 1643, which really meets several key levels. Those levels being 1643 being the 61.8% level or retracement level of this whole run. It would also correspond very nicely with the 50-day moving average, and it also, which the price has been pretty much abiding by for some time now, and it also fills this little gap. See this little gap here between the 5th and 8th of August, which was over the weekend, which is why we've got a gap there. And quite often charts will retrace to fill in that gap. So that would also fulfill that technical requirement as well. That would get the price of gold back down to quite possibly being oversold on a daily basis, and that would be a great time for us to start to trade to the upside. So I think for the more aggressive, there's an opportunity to short sell up in this area here. So say somewhere between 1830 and 1870, and it's really, day by day, hour by hour call on that one. So I'll just have to advise as we go. Looking to short that, start to work our way out of the shorts somewhere just above 1700, and perhaps leave half open and try and run it down into the 1600s, take our profit on the short, and then look for the rebound back upwards. So that's the plan on gold. I think there's a very good series of trades available there. As I've written in the daily alerts, they won't all be successful. You can expect at least 30% of them will not succeed. But that is no reason to participate, and it's certainly no reason to not take exits because you decide you're going to turn a short-term trade into a longer-term one, because this is so volatile, this market, that it could do a bit of damage to your account on paper. So my absolute recommendation to you is that you treat this as a series of transactions, 10, maybe 20 transactions over the next 6 months, and just accept that we are going to have losers. So we go in on a very structured basis. We're just playing the probabilities, and I think we're going to do extremely well. Certainly the volatility in gold and the fact that we can buy gold stocks in effect, not shares, but we can buy in effect exchange traded funds that just trade as shares that are linked directly to the price of gold and silver. So therefore there's not the additional requirement that we have in there with stocks where you've got to have enough liquidity to actually drive the price. The price of these ETFs just goes up and down with the underlying commodity. So that's the plan on that one. Now let's go back and have a look at some of the other charts. So we'll look first of all at the S&P 500, and you can see we had 1101 was our first retracement level. It stopped at exactly 1101, so that's why I say the technicals are still working reasonably predictably at the extremes. It's all the other stuff in the middle that's proving to be extremely difficult to trade. So the answer is we just don't trade very much in this zone. We've just got to pick off the the extreme opportunities. Now, at the moment, we've got a range between 1101, which was this recent low, and I've put a retracement scale from the high on the 7th of July, and it gives us 1198.99 as the first level. We've had a slight overrun on that, but I would still see this area as being the top of the short-term band. So our band is roughly between 1100 and 1200. I think given the strength of the move on Friday night, or the reversal on Friday night, I wouldn't be surprised to see this level break. So it's possible we could see a move to 1259. Now again, that would correspond with this this top retracement level and also the 50-day moving average. So that would kind of make sense. So I think a run to 1260 over the next few days or few weeks is possible. I'm not saying it's going to happen, I just think it's possible. However, if there are negative triggers out there, then we've got to look at some downside targets, and the downside targets, in the same way that we had with gold, could be a retest of these lows, so 1101. We could get a bit of an overrun down into this 1080 zone, or we could run down here to 1019, let's call it 1020. So that would be the next support area. So on the S&P, which is really our gauge of sentiment, and stocks in general, we're in a mid-zone, could go either way, so it's really just a matter of continuing to hold fairly small exposure. We've got one short, one long. We've got AMP as a possible short, and I think that's the appropriate balance to have. Really looking to make our money out of gold and silver, and perhaps a bit of index trading as well. Let's have a look at our market now, at our index. So this is our index on a monthly chart. You can see we had a significant dip under it. We went just a little bit below this third retracement level, but we've regained the lows. Again, we seem to keep coming back to this area around about 4,200. We will open up above this on Monday morning. I would expect we'll open around about the 42.20, 42.30 mark on Monday, and we'll just have to play it day by day from there. But certainly I don't see a great deal of upside. So we've got a range here from around 3,800 to possibly around the 4,400 to 4,450 area. That's the range. We're sitting 4,200 at the moment. So again, same reason. Don't really want to be trading in the middle of this zone because it could go either way. And it's not just the fact that it could go either way, it's just that markets are so volatile that they move very quickly, so it doesn't really give you much time and scope to get out of the way. This is the finance index, looking very similar to the main index, so the same comments apply. Materials, similarly. We'll have a look at energy. Same pattern there. So there's really no change. All indices are really performing in the same way because they're all being driven by the same sentiment. And here's the Small Ordinaries Index, the XSO. You would have normally expected this index to be somewhere down around 2,000 or even below in a normal market panic like we've had. The fact that it's still up here at 2450 is just a great sign for when we get some liquidity back into the market. So I'm accumulating a list of all the stocks that are proving to be the most robust during this period. They'll be the ones that will fall less and will rebound most quickly when we get some liquidity and momentum back into the small cap sector. So that area is really just a matter of wait and see. There may be some opportunities set up in the small caps, particularly for small gold producers. So we'll just have to wait and see how that unfolds. I'll certainly be looking at buying some of the gold producers as we get closer towards the bottom of the correction in gold. So let's just have a look at a final strategy slide then. So our strategy with respect to stocks, the S&P could go either way with short-term extremes between those 2 points, as I indicated on the chart. If we get breakouts either way, which are also quite likely, then there are the two targets on a more medium-term basis if we get a breakout. Gold, we're looking to short sell. Now, for the purposes of getting into the trade, if you want to short sell gold, then I'm taking the middle point, so the 50% retracement level of 1855. So I'm suggesting if you want to do this, you might think about a trade short selling at 1855 and place your exit at 1890. If the price gets up to 1890, then it's showing more strength than what than I think is likely if we are going to complete an ABC correction. So to me, that's the logical place to put our exit. And then our target for that short sell would be somewhere between 1720 and 1643. So I think the smart way to play that would be probably to take half off the table at 1720 and let the other half run. On a 6-month view, if you don't want to do that shorter term trading and you don't want to do it with CFDs, then you have an alternative. And that alternative, but definitely doing it on more a 3 to 6 month view, would be to buy just as you buy a share, so it's done through your stockbroking platform. You can either buy an ETF called GOLD, which is the Australian dollar gold price, which has been performing quite well lately, and we'll have a look at that chart as well. buy that on a pullback because we can't short sell these ETFs, we can only buy them. So GOLD would be a possibility, and just whatever price that corresponds to when I've signaled that I think gold's at a low. Or if you want the US dollar gold price but hedged back into Australian dollars so that you have no currency losses if the Australian dollar continues to strengthen, then you could buy QAU. Now, neither of these are particularly liquid, so it's really just a matter of putting an order in the market and seeing how you go. But I'll give you those levels closer to the time. Now, with respect to silver, I really don't have a view on shorting silver at the moment. I think we'll just go with gold, and I think if gold does start to move back down in a C leg, then we might look at shorting silver as well, but I really don't have a price to give you at this stage. To me, the ideal buying zone would be somewhere between 36.80 and 37.80. So silver down in that area, I think we'd be looking at buying silver. Or again, the 6-month view is to, if you want to buy it like a share, then you can buy the ETF, which is ETP MAG. So if silver gets back into that zone, then I think starting to accumulate that stock is probably a pretty good place to do it. Now let's have a look at the Australian dollar gold price, just to show you that it's also technically behaving itself pretty well. This is a weekly chart of Australian gold, and if we take a run, so we had a good upsloping trend line there. We then got the start of a new move, which was here at 134, and basically this is 1/10 of an ounce of gold. So if you multiply these prices by 10, you get pretty close to the gold price. So in Australian dollars, this run started to move at about 1,340 Australian dollars. It peaked out at 1782. Our first retracement level was 161 or 1610, and we got to 161 on the money, so 1607 on Friday. So that's about as good as it gets in terms of retracement levels and behaviour. You can see from the RSI down here that we're quite massively overbought. We're due for a correction. The last time we got to this level, which was in June of 2010, we had a 7-week decline. I'm not saying this will be 7 weeks, but just to give you a bit of an idea. So 7-week decline, we've had one, so it's quite possible we could have 4 or 5 or 6 weeks of decline left. And if it pulled back to maybe this 151 or 1510 level, then I'd be looking to be buying around about that point. That also corresponds to these highs in June of 2010 and February of 2009. So that level there would make a lot of sense. So that's it for this week. Pretty long, I guess, but it was important to give you that overall perspective, and we'll obviously keep communicating during the week and talk again next weekend. Cheers.